Resolv has lost 93% of its total value. Its market cap has been crushed down to just $11 million. Two major top-tier crypto exchanges responded by completely dropping the asset from their platforms. This is a real-time study of a protocol fighting for its survival. The central question is how a decentralized architecture physically continues to operate when its value and its liquidity are abruptly drained. A 93% drop signifies a systemic failure that forces the entire network into pure survival mode. To see how the protocol reached this point, we have to look at its baseline intended mechanics. Resolv operates as a token on the Ethereum network. Its primary function is to power the decentralized finance protocol behind USR, a stablecoin. This diagram outlines the intended backing mechanism. USR is collateralized by Ethereum and Bitcoin. Users deposit those assets, and the smart contract issues stable USR in return. Resolv Labs designed this infrastructure specifically to compete with the massive, entrenched players dominating the stablecoin market. The original architecture was ambitious and functionally sound. The current crisis stems from an operational breach, rather than a flawed initial concept. In March, the protocol suffered a severe smart contract exploit. Hackers discovered a vulnerability in the code, allowing them to bypass the strict Ethereum and Bitcoin collateral requirements. By injecting malicious commands, the attackers forced the contract to mint vast quantities of the USR stablecoin out of thin air. This triggered an immediate inflationary threat. Unbacked tokens multiplied, pushing the ecosystem toward a death spiral that destroys the peg. As this illegal supply flooded the open market, investors panicked and began pulling their legitimate liquidity. The exploit broke the mathematical trust holding the stablecoin together, creating an instantaneous crisis of confidence. To halt the death spiral, the Resolv developer team had to execute an immediate defensive maneuver. Their primary strategy was a massive token burn. Looking at this tokenomics dashboard, out of a circulating supply of around 380 million, the team managed to isolate and burn tens of millions of the stolen USR. This eliminated the illegally minted supply from the open market, neutralizing the immediate threat. This rapid incident response demonstrates a capacity for emergency protocol management, limiting the scope of the exploit before it became irreversible. Because of this mitigation, the core operations of the protocol survived the attack and continued to function. Most young decentralized finance projects do not survive a breach. Their liquidity drains out and they stay down. Surviving an exploit requires immediate supply-side mitigation. It is a brutal operational test, and Resolv passed it. Technical survival does not guarantee market recovery. Resolv is currently trading under a risk discount, which is actively suppressing its valuation. The first structural driver of this discount is institutional fallout. Following the exploit, top-tier Korean exchanges Upbit and Bithumb entirely delisted the Resolv token. Losing access to Tier 1 platforms damages market liquidity and restricts retail access to the asset. The second driver is the persistent threat of a repeat exploit, a risk that follows any young protocol after its first major breach. The $11 million market cap is a direct penalty for lost trust and diminished liquidity. The market is pricing in the institutional fallout, not necessarily a failure of the stablecoin mechanism itself. The hard data of the current price action reveals where the asset sits now. This candlestick chart tracks Resolv's historical valuation. It peaked at a valuation above 40 cents in June 2025. Following the exploit, the price traces a descent down to its current trading reality near 3 cents today. Market sentiment surrounding this tight trading range is fragile and highly reactive to minimal volume. The immediate technical test for the token in the coming weeks is straightforward. The price must maintain support above its previous October low. Breaking directly below that specific horizontal level would signify a catastrophic loss of the asset's remaining structural floor. The asset is currently consumed by the struggle to find and defend a baseline. It is not currently positioning for a rally. The structural data and the market response point to a single conclusion. The asset is caught between survival and fractured trust. On the positive side, the team showed fast incident response and the core protocol remains active. But these metrics are weighed against lasting structural overhangs, exchange delistings, and the ongoing risk of a repeat exploit. Based on the data, this is strictly a recovery story right now. It is not a secure growth play, and there is no guaranteed bounce back. The highly practical approach in this scenario is to patiently watch it from a distance, but absolutely do not chase it. For those monitoring the asset, observable liquidity still exists on Binance, OKX, and Uniswap. True resilience in decentralized finance requires patching the code, but it also demands the long, grueling process of earning back institutional and retail liquidity after the mathematical trust has been broken.